Your first tax bill just landed, and it is about 50% bigger than the number you were expecting. You saved up, you did the maths, and HMRC is asking for half as much again. So here is the answer, straight away before anything else. You are not being overcharged, nothing has gone wrong. You are being asked to pay for 2 tax years at once, and it has a name. It is called payment on account, and almost nobody sees it coming the first time. Let me show you exactly what happened using round numbers. Say the tax you owed for the year was £2,000. That is the figure you set aside. That is the figure you were ready to hand over. But when you file, HMRC does not just ask for that 2,000, it asks for the 2,000 you owe for the year just gone. And then it adds another 1,000 on top as an advance towards next year's bill. That extra 1,000 is your first payment on account. 2,000 quietly becomes 3,000. Same income, same tax, a bill that is 50% bigger because you are settling this year in full and starting next year early on the very same day. So why does HMRC do this? Not to punish you. The logic is almost boringly simple. HMRC looks at the tax you owed this year and assumes you will owe roughly the same next year. So instead of waiting another 12 months for it, it asks you to pay half of that estimate now and the other half in 6 months' time. You are not being charged extra tax. You are paying next year's tax in advance in 2 installments. Every penny of it comes off what you owe next time. And that second half, that is the part that catches people twice. Your first payment on account is due on the 31st of January alongside your actual bill. Your second payment on account is due on the 31st of July. So 6 months after that painful January payment, when you have almost forgotten about it, another one lands. 2 dates, 2 installments, one nasty surprise, followed by a smaller, quieter one in the summer. Now, does this happen to everyone? No, and this is worth knowing. Payment on account only kicks in if your last tax bill was more than £1,000 and less than 80% of your tax was already collected at source through something like pay on a wage. So a full-time employee with a small side hustle often escapes it because most of their tax is already handled through their salary. But a self-employed person whose income arrives untaxed usually crosses that line the very first year they owe real money. If that is you, payment on account is not an if, it is a when. Here is the calm way through it. The reason this feels like an ambush is almost never the amount, it is the surprise. Nobody told you that first bill would be 1.5 times what you thought. If you had known the number in advance, you would simply have saved for it, and the letter would have been a formality instead of a shock. That is the entire trick. Not earning more, not clever accounting, just seeing the real number coming months before it is due. The JR Former UK Sole Trader Tracker is built to show you that figure as you go, including the payment on account. So the January total is a number you have already got sitting in an account, not a number that knocks the wind out of you. One last thing, because it genuinely helps. If you know next year will be leaner than this one, you can ask HMRC to reduce your payments on account so you are not overpaying on income you will not actually earn. But be careful. If you reduce it too far and end up owing more than you guessed, HMRC charges interest on the difference. So reduce it only when you are genuinely confident, not just to soften the January hit. So no, your first tax bill is not wrong and you are not bad at this. You were simply shown a 50% bigger number with no warning on a system that assumed you already understood it. Now you do. And next January, that same letter is just a number you were already ready for.